Okay. Good morning, good afternoon, good evening from wherever you're joining us from today. We are delighted to have you join us for this session. My name is June Kangula. I am the project lead at ABAN, and this session is brought to you by ABAN in partnership with MsFiT Ventures in our commitment to expand our investment knowledge and opportunities for angel investors across the continent. And today we will be exploring debt investment as a tool in angel investment. And also we will be discussing the opportunities, some of the returns and the scalability that comes with debt investment. And we'll be hearing from expert speakers and looking into real world case studies and what has been done previously and what will be done and how you can be able to be part of that. And without further ado, let's get started. First, I would like to know where you're joining us from. I am joining from Nairobi, Kenya, and you can feel free to put it in the chat so that we can know where you're joining us from. I know there was a satellite that was launched, and maybe some of you are joining from Pluto in space. We would like to know if Elon Musk's internet was able to get you join us today. So I can already see Nairobi, we have Botswana, we have Gabon, Norway, from London, from Zimbabwe, from California. So you see we have diverse group here. We have Angola, South Africa, Nairobi, Togo. Hi, I would love to come to Togo soon. And just so that we can see, we have everyone from all over, and we can see that this conversation is indeed timely and important. And I would like us to walk through the agenda for the session before we get into the session. I will have a welcome and introduction, and we'll have a session understanding debt as an investment vehicle and MsFiT Ventures' innovative debt model. We will also hear from an angel investor herself, who also has a background in debt investment as an angel investor. Then I will have an interactive workshop where we'll talk about building a debt investment strategy and Q&A. Also, feel free whenever we are having this conversation to have your questions in the chat box so that the speakers can be able to look at it and answer as we go. Feel free to interact with us. Let us know your thoughts. Let us know if you have been able to be a part of a debt investment deal and how it went. We would like to hear real life cases and experiences as we usher those ones who are new into debt investment. I will also have closing and next steps so that you can know how you can participate in a MsFiT Ventures fund and be a part of the trend. And now I would like to introduce Fadilah to come come forward and introduce and welcome you properly for this session and to just introduce you to ABAN. Fadilah, the floor is yours.
Thank you very much, June. Greetings to everyone, and it is really a pleasure to welcome you all to this important session, which is Beyond Equity, Unlocking the Power of Debt for Angel Investing in Africa. As some of you may know, at ABAN, we have long championed the growth of early-stage investing across the continent, and while equity has often been the headline act, today we're here to explore a vital, often underutilized tool in the angel investor toolkit, which is debt. So, debt financing. We know that when applied creatively and strategically, it has the power to unlock capital, reduce dilution, and offer founders with more flexible growth path, which is something that we really need on the continent, especially given that the African diverse market as well as dynamic market offers so much opportunity. So this conversation isn't just timely, right? It's very important. As angel investor, we must broaden our thinking and adapt our financing model to meet the real need of our entrepreneurs and the evolving landscape we are currently operating in. So let's dive in. challenge assumption, and reimagine what's possible beyond equity. And for you joining us today, I would just like to let you know that and to share with you that today ABAN is a community of over 6,000 angel investors, pretty much organized across 75 groups, syndicates, and network in more than 37 African countries. And today we are very happy to share with you that we have been able to deploy together a total of 22.5 million across 408 deals. And this has mostly been equity investment. But I'm also very proud to share with you that last year we signed a partnership with MsFiT to drive debt investment within our ecosystem. And I'm more than happy to have you join us today to discuss about what is possible in the debt ecosystem and how MsFiT will be able to drive this new pool of capital that will support the companies that are emerging in solving at scale some of the challenges that we face on the continent today. So let's have a wonderful session, and I can't wait to engage more.
Thank you, Fadilah. Thank you. It is important that you have highlighted together that we have been able to deploy more than 22 million, and most of it has been equity. We're now looking at debt investment and how our angel investors can leverage this. And now we'll get into the session itself. And I would like to welcome both Jill and Egla, who will be taking us through this session, understanding debt as an investment vehicle and MsFiT Ventures' innovative debt model. I would welcome either Jill or Egla to take the stage.
Thank you. Hi, everybody. Thanks, June. That was a really good introduction that Fadilah laid out for us of where ABAN is, but also the incredible opportunity for debt that we're talking about today. But anyway, we'll get into that. So myself, hi, everybody. I'm Egla Ntumba. I'm the CEO at MsFiT Ventures, and then I have Jill Curr with me over here smiling, and she is the CIO at MsFiT Ventures. We are the co-founders. Myself, I have experience as an ex-entrepreneur, ran a typical SME for close to 10 years, went into banking, deployed over $1 billion in debt transactions in trade finance at Standard Chartered Bank, and then joined DP World's Corporate Venture Capital Fund, where I was focusing on portfolio support for 10 startups for digitizing the supply chain healthcare industry in Europe, Asia, as well as Africa. And then my co-founder, Jill, she has led 11 transactions on the continent on the VC side, deployed over $11 million at that early stage side. So lots of wonderful VC experience over there. And then she led the DP World's funds exit strategy as well. And then, of course, we have a wonderful team of advisors who are supporting us. I know most of you are familiar with Launch Africa in this space. Janae Duplessis from there is one of our advisors, and a few other wonderful humans. So super, super excited to be here. Just wanted to lay that out a little bit. Okay, next slide, please. Okay, so we're going to talk about just understanding debt as an investment vehicle. Okay, next slide. But first, I'm going to start with some real fundamentals. Next. Okay, fundamentals. Okay, so we know in the universe of businesses, you have here at the bottom, we can see the stage of the firm. So we have right here on the extreme left, all the way from inception stage businesses, all the way up to really late stage businesses. Now, if we start from the top right there, we were talking about public markets. So this slide really captures the fundraising dynamics in the world of business from inception stage all the way to really mature businesses. So mature businesses that are publicly listed on a public stock exchange, like the Johannesburg Stock Exchange, the NASDAQ, or any of those stock exchanges, these are public companies, and they raise capital from public markets, either equity or debt markets that are public, as you know. And then everything else below that are private markets companies. So in the private market, you have very, very early stage companies, basically an idea and a pitch deck, all the way to much more established, larger companies that get funding from the likes of private equity funds. Right. And then on this spectrum, you have, of course, your startups, you have your SMEs who aren't as technology first. And then the funding can range from, your own bootstrapped capital to angel investors, which most of us in the room here are, to venture capital and private equity. And then the lighter gray blocks are the debt blocks, which are typically for your traditional SMEs that don't usually do the venture capital equity sprint. Okay, now that you have this idea, next slide. Okay, so as I've explained now, the private market has these variations of funding, right? But typically these SMEs, and in this particular context, when I'm talking about SMEs, I'm talking about small businesses. So this can be technology businesses, aka startups, or SMEs. Okay. And typically the smaller businesses in the private market have access to equity funding, which is your typical venture capital sprint, where you raise equity financing, you give a share of ownership of your business in exchange for capital. And typically these are businesses that are not building, especially the ones that are building for the venture capital track, are not building to be profitable from day one, but they are building with a wonderful idea that's going to grow really, really fast, and they're trying to try something new. And then, of course, you have, other businesses that are also small, but are not growing at that same fast pace and are not building with that incredible speed from day one. They're building with profitability in mind from day one, because maybe I have 2 suites, I sell a suite, I make a profit, I go buy 3 more suites, blah, blah, blah. So you're building with profitability from day one. And these businesses typically are able to access debt to fund that repeated success, right? Because they have that profit and the cash to be able to sustain that. And then, of course, there's grant funding, which people often say is free capital. It's really not. There is a big impact. We can't see your presentation. Oh, is that true for everyone?
I can see it.
I can see it as well. Yeah.
I can see it too.
Okay, so okay.
It might be
Tomika,
something
maybe
on his.
you can
I think
log
it might be
log
something
back
on
in.
his screen.
Yeah, maybe log off and log back in.
Or
Because
he changes the, he touches his camera.
okay. So anyway, right. So with regards to grants, I mean, whether technology or non-technology businesses can, of course, access grant financing. And this is typically to cover, a high cost base for an idea that maybe has not been proven out yet. Maybe you're trying to do research into something really cool and interesting and different, but you obviously can't cover your own costs. So you get grant funding to support you to do that. So each of these different kinds of financings are very necessary and have very different use cases, but they have to be used in conjunction with each other because they play a specific role. Anyway, next. Okay, so now, because we are amongst mostly investors in the room, and sorry if you're not an investor in the room, but hopefully you're going to be an investor soon, but let me explain to you a little bit of the return profile. So now we've understood the kinds of capital that's available to private companies. I explained what's happening in the public market. But what is the return profile? When a business, a startup typically, so when I'm saying startup, I'm talking about tech-enabled, tech-first businesses, right? What is the return profile that you as an investor can typically get from a startup investment? Typically, if we look right at the top of the pyramid over there, LPs want a 3-time return on their capital for having invested in one of these really fast-growing businesses, right? Within a 7 to 10 year. But in order for the LP, who's right at the top, to get their capital back from this investment, the seed stage VC, that earlier stage investor, or it needs to make 100-time return on their capital, because the power law in venture capital, in a portfolio of 10, 9 will probably fail, 1 will provide you the return that will then cover and make up for the failure of the other 9. So that 1 is really that 100x and everything else fails. That's how you're able to return the 3x. But how does the VC do that? The VC then needs that one startup that's going to do really well to have over $1 billion in exit. But in order to do that, if we assume just a 10-time multiple on revenue, that means the startup within that 7 to 10 year period needs to grow from 0 revenue, so an idea on a pitch deck, to $100 million in revenue within 7 to 10 years, which is an incredibly fast pace of growth. But that's great because there are some businesses that are able to do that and to achieve that and to provide these wonderful returns. So next slide, please. Okay, in the US, still in the spirit of return profiles with venture capital, in the US, if we look right there in the last column on the right, angel investors have typically been able to generate a liquidity of 2.6 times return on their investment in a 3.5 year period. So in 3.5 years, boom, 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 you get a 2.6 time return on your capital. Great, everybody's happy. But in Africa, we have a really nascent venture capital ecosystem. So a lot of angels have seen themselves having to hold equity positions for 7 to 10 years without necessarily getting that liquidity. But also, to be fair, there is a lot of underreporting going on. On the continent, which there are many wonderful organizations working towards this, like Africa, the Big Deal, etc. But that information is not as freely available in Africa. And some angels are really, we've spoken to so many angel investors who are just simply getting fatigued because they do believe in venture capital. They do see that wonderful opportunity and they believe in its importance, and so do we. But there is definitely that fatigue that is setting in terms of being able to see some liquidity for that belief that we've had. But anyway, our ecosystem is still really, really young. I mean, 10 years old from 2015, and the US is industry is almost 80 years old. These are completely, I mean, if you think in human terms, these are completely different humans at different stages of their lives. So of course, the US has this wonderful 3.5 year return. And our ecosystem is still growing. Next slide, please. So now enter private credit. Now remember, I spoke about public markets and private markets. So obviously private credit, we're talking about credit to the private market, right? So no public market debts here. So this is debt that goes to private companies, and it ranges a wide spectrum. It can be venture debt. Of course, venture debt is not here because venture debt kind of really falls under VC, because really you're taking a bet on whether this unprofitable startup will be able to raise more equity financing. That's why you give them debt to bridge them over. So that's why venture debt strictly doesn't fall here. But anyway, so these are debt products that go to private companies, and it can be anything from, senior direct lending, where you're providing a loan, but it's senior to any other facility. It's secured against assets. You have new unitranche loans, which can be a blend of different debt instruments into one instrument, mezzanine, which kind of sits between equity and debt financing, and distressed credit assets. And depending on the risk appetite, you can make a higher potential return, for example, with distressed credit, where you have a 20% IRR. And that's really a 20% annual return, right? Because we're talking IRR here. So versus, of course, senior debt, which is senior direct lending, rather, which is on that 6 to 8% debt IRR spectrum. But really, based on your risk appetite and how long you want that capital to be locked in, there is that opportunity to play around with different debt instruments and be able to create a return. But the big takeaway here is private credit is more steady, sort of slow burn, steady returns. If you remember from the previous slide, where with the 2.6 time return that US angels are making, that's about a 27% IRR. That means annually you're basically making 27% on your money, versus here, I mean, even at distressed credit, you're making 20%, So it's slower, steadier, but you're able to get that earlier liquidity, as you can see. I mean, right at the bottom here with corporate bonds, for example, you get daily liquidity. And then with senior direct loans, you get sort of 5 to 7 years where you actually get your capital plus interest back. And we sit kind of a little bit below that because we do a 4-year kind of lockup period at MsFiT Ventures. But yeah, so this is a really interesting opportunity as an angel investor to diversify your portfolio beyond just what you normally would get from your VC and equity portfolio, to do something else, the slower, steady burning that gives you a little bit of that energy to keep going and keep believing in early stage businesses on the continent. Next slide, please. I'm going to hand over to Jill.
Thanks, Egla. You always frame things very well. I really want the session to just highlight that Africa is a debt opportunity. If you dive into the second slide, next slide. So we're early on in the venture capital equity phase of entrepreneurship in Africa, but venture capital is a niche tool because it crowds into the best deals. You can see this here. This is Africa, the big deal. We'll give them the credit where credit is due. And in kind of the last 5 years, since 2019, 28 startups actually received nearly half of the funding. And $3.9 billion went to just 9 startups. And if you go to the next slide, I want to highlight that if you're talking about, there are 245 million SMEs, owner-operated SMEs in the continent. And they are, and Egla always likes to joke that if you add the 3,000 to 4,000 venture capital deals that have happened since a VC kind of started to 245 million, it's still 245 million. VC has only backed 0.001% of the SMEs. And these SMEs are really struggling for one thing and one thing only: capital. Only 20 to 33% of these African SMEs have a loan or a line of credit, despite them being the major source of impact. SMEs account for 50% of Africa's nearly 2 trillion annual GDP and 60 to 80% of the jobs. And if you head to the next slide, please. And if we outline this just a bit in a bit more context, I really want to highlight that there is a 330 billion annual SME financing gap on the continent. And in the past 20 years that VC has been around, we've raised around 73 billion. In that same amount, only 12 billion was raised for fintech. So even when we say that VC is all about fintech and is doing the most, the fintech raise doesn't even cover South Africa's SME financing gap, just South Africa's, which is a $20 billion financing gap. So all this to say that this is a very underserved market. If you look at Africa's private credit market size, it is only 4.5 billion. And again, I want to highlight that we're talking about a $330 billion annual financing gap. And even though we've got a 2 trillion global private credit market, the US is the main beneficiary of that. Africa's private credit market only accounts for around 0.3%. And of that kind of private credit, it only covers about 1% of the gap that we're actually facing. If you go to the next slide. And what's interesting is that despite fintech being around and all of these amazing microfinanciers, banks are still the major source of finance for SMEs. In 2020, all other lenders accounted for like a 1% of SME loans. But if you're looking at kind of the bank's exposure to SMEs, only around 7% of their loan book goes to SMEs. And we've seen this in South Africa alone. South Africa, they saw the local banks put aside around 60 billion rand in funding to actually fund these SMEs. That has grown in value over time to around 80 billion rand because they are really struggling to deploy. And if we'll highlight kind of why in the next slide. So despite the fact that you've got this massive gap and banks are the ones that are really solving for this major problem, despite all of the 12 billion that went into fintechs coming through, the banks are still the major source of funding that the SMEs can go to. And there's a big challenge for them because they've got high transaction costs. They have a collateral-based lending model. And most of these SMEs lack the operating history because a lot of their transactions are cash-based. And they also don't have the credit scoring frameworks to actually assess these SMEs. The way banks assess SMEs at the moment is they'll credit rate the founder. And unfortunately, as we know, as angels and so forth, what kind of founders usually pay themselves a lot so that they've got nice credit ratings? They're making sure that their business is evolving. So if banks are the major source, but they're struggling to deploy into these SMEs, how do we actually solve this issue? And that's where financial intermediaries step in. If you move to the next slide, please. Let's highlight how difficult it is to get debt with two examples, one from our venture capital equity days and one from our debt days, which is the first investment we've actually completed. So MDOS Global, this is our venture capital deal. They were a tech-enabled diagnostic center provider, and they could get a diagnostic center up and running for $100,000 and get it profitable within 3 to 6 months. They struggled to get impact funding because they were profitable, and everyone said, why do you need it? They struggled to get equity funding because they were building diagnostic centers. There was this massive infrastructure element to their business. When they wanted to raise debt from their local Nigerian banks, this was before they annexed US dollar-based deposit lending. But what they were offered when they had US dollars to put in a deposit was a 30% annual rate on US dollars. And they required the collateral of 50 to 100% of the Nigerian naira loan that they would have issued. Because of this, MDOS had to keep waiting like that 2-year period to raise equity, and using equity and diluting themselves to fund a 3 to 6 month working capital gap. And that just highlights how difficult it is for these businesses to get equity, to get debt. And if we highlight Horizon's activation, this is our first SME that we've invested into. They do around $250,000 in revenue. They particularly provide brand and events and wellness programs for large corporates to incentivize and create company culture. They've been operating for 25 years. They've been consistently profitable with EBITDA margins ranging from higher than 20%. The only facility they have been given by their local bank is an overdraft. That's it. They've never received a longer term 2-year working capital facility or a term loan to help them scale or get to more customers. And because of that, they can't then expand into other regions of South Africa. They can only focus on the Western Cape. With us, we aim to double their revenue by actually expanding them with existing customers. And they couldn't have access to this before without us. Maybe let's dive onto the next slide. I want to highlight that, the 2 billion of debt has gone to some interesting startups, and there's been some great success stories. Most of them very infrastructure focused and very large check sizes. You'll notice that across the board. For that 2 billion in debt that was raised in, the past 5 or 6 years, 47% was clean tech into the likes of Yellow. They're an asset financier for solar, and they have digital devices that they use to secure that. They raised 20 million in debt from a consortium of investors, and then were able to go on and raise 14 million in Series B equity financing. You also saw fintechs like M-Kopa. They're the big name when it comes to debt. They also had an asset-backed approach as well, utilizing phones, right? And paying off these phones using the digital tools. They had initially secured 250 million, and 200 million of that was debt from Standard Bank, and then went on to secure a further 51 million from the DFC. They also managed to, another example is mobility, around 13% of that was into those pieces. Again, logistics, asset-backed. Spira was able to raise 63 million in a loan and then moved on to raise a further 50 million to kind of keep expanding. So these are some really successful businesses that have been able to raise large check sizes and debt to be able to deploy and provide value. Maybe you can go into the next slide, please. And I'm going to hand over to Egla now that you've got a bit of an understanding of what's been happening in the African continent and why I keep saying Africa is a debt opportunity. I'll let Egla highlight why MsFiT Ventures has an innovative debt model. Thanks.
Thanks, Jill. It's always really jarring to see when you see that big bubble with the 330 billion, and then you see the 4.5 billion, that's the private credit market on the continent. There's so much opportunity for that market to just grow, even to just take up the SME funding gap that we have. Anyway, next slide, please. Okay, so we are currently raising our proof of concept loan book. And it's a $5 million loan book where we will be lending to up to 28 female-led and gender-diverse SMEs. So, but with this loan book, why it's a proof of concept is because we're trying to prove something, right? But these are the 4 things that we're trying to prove with this particular POC. So we're trying to prove that we can provide affordable local currency debt to the SMEs. We don't want to burden SMEs who are earning rands or whatever local currency, right? But we're in South Africa, so rand. Who are earning rands and then having to pay US dollars because that burdens them so much more because then they first need to, you know, earn the currency devaluation and then pay back the interest rate. And for those of you sitting in Egypt or Nigeria, you know the impacts of of the currency devaluation. So the second thing we're trying to prove here is that we're mitigating risk by targeting female-led businesses. I'll tell you why later, but this is quite a big one and a big core to what we're doing. And then the next one is we just want to give access to financing, access to trade finance, to working capital, and hands-on support. And then, of course, the last one is creating early liquidity for investors. We know that investors are fatigued from having to kind of wait for that 7-10 year mark, and we want to be able to prove that you can have steady returns that provide you with that early liquidity while you wait for your unicorn returns from your equity portfolio. Okay, so next slide, please. Okay, so I spoke about why we're focusing on women. First, out the gate, let me tell you, we're not doing it just for vibes. We're doing this, it's a commercial decision. That's why we're focusing on women. On average, women are 67% less likely to default on debt than their male counterparts. I mean, if you give me those odds as a lender, I'm going to focus on the people who are likely to not default on the debt, right? And then women are obviously 35%, offer a 35% higher return on invested capital, provide 2 times more revenue per invested dollar. This is all research stuff, okay? Like, I'm not making these numbers up, guys. And then another thing that's really, really important to us is being able to reinvest in community because we want to create sustainable businesses that are creating jobs. A big thing that we want to also achieve with this proof of concept is create 1,000 new jobs. So reinvesting in the community, women are 90% more likely to reinvest in the community than their male counterparts. So this is a really big reason why we made the decision to focus on female-led and gender diverse teams. Jill will tell you about gender diversity a little bit later, but this is why. Next slide, please. And also, like, I always have to explain why, because believe it or not, people always have questions on, oh, but why are you focusing on women? And like, why there's no pipeline in it. As you can tell, that bothers me a little. Anyway, there are 3 main reasons why small businesses fail on the continent. On average, 70 to 80% of businesses fail in their first year on the continent, or even the first 5 years. So the main reasons, there are 3 of them. 1, access to capital. 3, market access. And then the last reason is regulatory hurdles. So, we don't have ins with the local government like that. So we're rather focusing on the two that we can help change. So providing access to capital is, of course, what we do because we're providing debt facilities. The second thing, access to market access. So we're creating a community around the founder to be able to provide value add. So remember I told you in my introduction that I was focused on value add. We will share our contact information, Wilson. We provide our value add through our provided value support, portfolio support at DP World's Corporate Venture Capital. And so how much value that provides to the entrepreneur, that's exactly what we're doing. We're trying to take that VC style of portfolio support to SMEs. So we see a great opportunity with angel investors who are seasoned, individuals within the industry who have too much to lose by maybe resigning from their day job where they're getting paid really, really well to start a small business, but then can release that energy by working with an energetic and dynamic entrepreneur. So we're seeing that wonderful opportunity, and that's why we're talking to you all, because then angel investors can really fit well and provide that mentorship and support to the market access to help us solve two of these three reasons that SMEs fail. Next one, please. Okay, as I said, we provide access to capital, but also all of these other things. So, for example, almost all of the entrepreneurs that we've spoken to so far, and I think I'm going to say all, have obviously a finance function because SMEs, believe it or not, get their, well, in South Africa, the SMEs that we're talking to get their financials audited, which is great, but usually it's by a bookkeeper who maybe doesn't understand the full picture of the business. And more often than not, entrepreneurs, even who have been running the business for years and years and years, don't always understand the numbers. When I was an entrepreneur, for example, and we needed a micro loan, there was a gentleman who was walking around who would literally give you cash and then write in his little book that he gave you this amount, and then every day he would come around and collect, the micro loan, and you would pay. He would scratch it down, scratch your name out, and then that's how he would go around to all the shops. But back then, I didn't know it was a microloan that we were getting because I just didn't have the language for it. And that's what a lot of entrepreneurs face. So a fractional CFO that can help strengthen that finance function and bring rigor to the business. That's one of the very, very big and important things that we're doing. But also leveraging angel investors to, provide market access, as I mentioned, in different geographies, to provide different perspectives. To help the entrepreneur plans exit routes, for example. If I want to partially exit my business, what do I do? If I want more coaching on how to lead a much larger business than what I started with, what do I do? All of these things. So providing a lot of support to make sure that we're not just giving them money and asking them to go away, but that we're helping them build a really interesting business. Next slide, please. Okay, but anyway, why should you care about all of these things? So where do we sit in relation to everything else that's happening on the continent? Jill obviously spoke to the fact that banks remain the primary lender to SMEs, but that in middle income countries, it's about 7 to 8% of the bank book that goes to SME lending. So there's this huge universe of SMEs that are not suitable for VC. You saw that pie chart with that thin little line that's VC backable. And they are not, getting the financing from the bank. So where do they go? So there's this universe. This is very South Africa specific because MsFiT is in South Africa. This is very South African specific. So as you see here on the right side of the chart, you have the online distribution. And a lot of the lenders right now, and the way that we think about it, are these ones that are focusing more on tech-enabled startups, maybe doing revenue-based financing, the likes of linear capital, or that are doing and even uncapped to some extent as well. But that's actually out of Kenya. And then you have sort of your fintechs like Lula or Spoon or Merchant Capital that are doing more of a higher volume. So their whole thing is doing higher volume. So many loans, and really getting your capital quite quickly. So in 24, 48 hours, you get your capital, you're happy to go. But that's not what we're doing. We have never issued anything in 24 hours. It takes us 24 hours to even open your email. I'm kidding. But so we are managing a really, really small book. At scale, we will only invest in about 28 SMEs, 16 to 28. So really, really small book, lots of hands-on support. It's really like really, really early days of private equity where we don't take any equity, but we just give you debt. And really over a 4-year investment period, so that's the length of our proof of concept vehicles, just 4 years. We start the SMEs off with a $5,000 check and then grow with them as their business is growing, like Jill described, horizons, doubling their revenue in a year. As that revenue doubles and they need more working capital, we're then that trusted partner that can be along with them, providing them that working capital along the way, as well as the support. So next slide, please. At very affordable rates as well, I should say. Okay, so with regards to returns, someone in the chat asked about smart asset financiers and the returns that they are providing. I think it was Cynthia, if I'm not mistaken. So based on our research, smart asset financiers provide about kind of a 6-ish% return there per year, kind of like a 6% IRR. And we're sitting kind of at that 5%. So very comparable returns compared to smart asset financing. Smart asset financing. Oh, no, wait. Cynthia was asking a different question, but I'm answering this question. So smart asset financing is more financing maybe like a technology company that's doing mobility. So they have this whole fleet of motor bicycles that they're generating revenue from, and they need a loan. So then getting financing for that kind of a thing. Anyway, so very much comparable returns there, even though we're just doing sort of pure debts to normal traditional SMEs. Yeah, okay. Next one, please. Okay, so but now, why should you care as an angel investor in the room? I mean, like, what does this mean to you, right? So next slide. All right, so this is just a little bit of an overview of what we're doing and everything. As I mentioned before, we're raising $5 million. 4.5 of that is going towards investment capital, and then 250K is going towards covering some of our OPEX until we actually break even, because we're very much operating like a business ourselves, even though we're money managers, but we're very much thinking like an entrepreneur first. I'm gonna stay PC and stay there, and then the other 250 is going towards technical assistance. So, and the way we're structured in South Africa, we're structured as a non-banking financial institution, so a financial intermediary. We are governed by the National Credit Regulator to make sure that our lending is ethical. We're not over-indebting any of the SMEs or doing anything weird. And then in order to get capital into South Africa, foreign currency capital, any of you who have tried it, you know that getting US dollars in is okay. Getting it out is complete pain in the bottom. So we have a Mauritius SPV through which we get capital into South Africa to just make it easier for everyone. And really, we provide tailored trade finance products, as I say, to female-led SMEs. There's opportunity for liquidity at year 2. Yeah. And actually, no, I'll talk about this in the next slide, but okay, next slide. Okay, so let's just cast our eyes just to the center of this picture with these MsFiT Ventures. How it all works. So I've explained that we are a non-banking financial institution in South Africa. And what that means, as an investor, an angel investor, you're sitting right there at the top where it says investor. The investor provides MsFiT Ventures with capital. And then we obviously provide back a dividend or an interest rate to the investor. And then at the MsFiT level, we provide financing to the SME, and then the SME, of course, pays us back principal plus, interest. And then we don't sort of intermediate the relationship between investor and the SME 100%, because actually, if you look to the 2 arms on the side, the investor, in the case you, the angel investor, get a lot of face time with entrepreneur through hands-on support, but also co-investment through the 20% equity discount on future equity rounds. We don't take equity, we just negotiate that for your benefit. So really, the 4 value props that we provide to angel investors: consistent returns, early liquidity, active SME role, and co-investment rights. That's why you should care. Next slide, please. Okay, so just to tell you a little bit about what we've achieved so far, we officially launched the funds in November 2024. And then back then we were able to raise a little bit over $50,000 from what we're trying to do. By this quarter, we've raised a little bit over 400,000 in hard commitment that we're already deploying, as Jill told you about Horizons that we've already invested in, and a few others that we're about to invest in. And then we're in advanced DD with our anchor investor. And then, of course, the aim is by the end of this year to really have raised the full $5 million dollars that we're trying to raise. And then next slide, please. And really our aim is to take you through a 10-year kind of journey where we start off with all of the things we've already achieved in these 5 months plus more, but really it's to prove, you know, the early liquidity, it's to prove the local currencies, to prove the stable returns over this 4-year period. And then in 2028, sort of raise a larger book, we were able to do more of this support and then expand out of South Africa into the SADC region, and then replicate that a few years later and do sort of a much larger Pan-African book as well. So this is kind of the 10-year journey that we're going on to support SMEs, to create jobs, to create that wonderful impact, and support the entrepreneurs that are changing the continent. Okay, so that's all for me from now. I think you're in for a treat with Olatokunbo.
Thank you, Egla. We're just going to have a brief break from Egla and Jill so that we have now been introduced. We have seen the difference between equity and debt. We have seen the African context. We have seen the opportunity. We have seen MsFiT Ventures model, debt model. And now, before we get into it and see how you can participate as an angel investor, I would like to hear from an existing angel investor, Olatokunbo Ige, who is a board member at ABAN, to walk us through some of the investments that she has done in debt. So, Olatokunbo, please, the floor is yours.
Oh, thank you very much. And thank you to everyone. Thank you for the time. And I think this is actually very much something that's really worth doing. So I'm glad that we've been able to do it and that we'll be able to do many more. Just very briefly, I'd like to put my presentation in context. A context in which we're dealing with a continent that is definitely very diverse in as far as this ecosystem, as the key word, is concerned. And so I am sitting in Togo. Togo is a West African French-speaking country with a population of between 6 and 8 million people. It is in, as I said, the West African region, and it has an ecosystem that's evolving. It's been growing all of 10 years, maybe, put together in terms of building. And when I'm talking about building, I'm talking now about just building the idea of entrepreneurship. So it's not even building structures as such, but just developing the concept and trying to push this forward. And this would probably be the same thing for a couple of countries around us, Burkina Faso, Niger, and so on. But anyway, so I just thought I'd put that out because a lot of what I'll be saying will be related to that. And so I listened very carefully to the MsFiT presentation, and I want to thank them because they gave an overview. But again, I repeat that Africa is very diverse. So yes, Africa is a debt financing opportunity, but a lot of work needs to be done before, during, and after. And that is where the evolving, should I say, model that we are working with in Togo might be of interest to you or to anybody. So I happen to be both an entrepreneur and a business angel at the same time. And I guess I'm also eventually going to become a fund manager of some sort. But all of these things have happened because I was asking questions. Entrepreneurship, yes, because I was interested in answering certain questions and providing responses to certain problems. And I'm an entrepreneur in diverse areas. So I'm in agriculture, I'm in products, I'm in services. And at the same time, as I said, I'm a business angel. So what has happened, or what is happening in Togo, and how do you get to where we are? Now, in my mind, and I realize now that what was in my mind is actually real, one of the key things that we need to do is to go back to the drawing board regarding what we think that entrepreneurs need. I think that more and more, the reality is that what we need is beyond equity. Even it's beyond money. We even say it's beyond the check, because, and we can see that many incubators, accelerators have come up with, training programs left, right, and center. And the more we're doing these training programs, the more we're realizing we need more than training programs. So this discussion, I hope, will take us to that next level where, as angel investors, we begin to look not just as we normally do at our resources we have, our what's that thing called, our contact list, our capacity to support, but it's also the length of time and the amount of energy that we can put into this in order to see an SME through. So for every SME, the primary objective is to make profit, is not just to build a business, but to sell something or to create a service that brings profit. Now, most of the time we hear banks, VCs, everybody saying they're creating a market. But I had difficulty understanding what it was that we were trying to create when we say we're creating markets, when you don't actually take an SME from Lomé or from Sokode, which is in the center part of Togo, to where, or bring that person from Sokode to Lomé, where they can actually sell what they have. There in Sokode, you're taking them in, putting them in front of a computer and teaching them access to markets, digital trade and whatever, but they need to sell these things they have. So how did we come to the project Togo Mall? This is one of the things that was on our mind. Many people were, asking for pitch decks and whatever's, talking about products that they hadn't seen, products that they don't even know how they were made. It's like there was just a disconnect between, and there still is that disconnect, which we're hoping will begin to move out of the way. A disconnect between the reality of the SME founder and those who want to support through investment. Because the whole grant thing, I don't think it's something we can talk about today, because I think the whole grant thing has not been as helpful as it should be, but I'll leave that for now. And just go back to this question of beyond equity or beyond even the check. Because even as we go into whatever new system we're putting in place, we need to keep it in mind. So I heard invest in community. And I think that is extremely important, because as Africans, we traditionally survive in community. So for every SME, every entrepreneur, it's not about the money that they're going to make for their pockets. For the average entrepreneur, it's about money that we are going to make, that we're going to put back into something else to build a community. So that in itself is key. I don't think with most VCs and, should I say, the usual and normal funding sources, anybody's thinking about those things. But these are the things that are affecting the SMEs. So what is it that I discovered in my first few years of angel investing? Is that the entrepreneur needs me to hug them, to hold their hand, and to put their head on my shoulder when they cry. And their tears might have nothing to do with the business, but might have to do with their family situation, their health challenges, their this, that, and the other, which is a reality. And for all of us who are even saying we want to have women as a focus, if you don't have that as focus number one, you're likely to miss it. And I can give you 2-3 scenarios. Scenario one, Madam X decides to become an entrepreneur, starts a business, and suddenly Mr. decides that she is now a CEO, so she should take more of the household responsibility. Simply because somebody gave her $1 million CFA, she was able to make $1,200,000, came home and said, oh, I was able to make $1,200,000, so I now need to pay back and whatever. And Mr. is in his mind saying, oh, now you have your own money, so now you will start paying the half of the rent or whatever else. Madam is not able to go back to angel investor and say, now my husband has decided this or the other. That's scenario number one. Scenario number two, Madam X is the head of the family, her family, because there is no support and whatever, but it's not just her immediate 2-3 children, it's 2 children plus aunties, cousins, mommy, and so on. And so somewhere in the middle of trying to build her business, mommy is falling sick, the children are not able to pay fees and whatever, and there is confusion because there is not enough backing and support for these SMEs to really evolve. So scenario number two. Scenario number three. Scenario number three is you tell Madam X that, you want to give her a loan, but then she needs to bring her uncle, her daddy, her mommy, her late grandparents, all the details that she doesn't have. For a business that she'd been bootstrapping for maybe 5 years, even before you came around, then you saddle her with all of these documents and you tell her, of course, the first thing is she's distraught. And that in itself needs help. So when we started Togo Mall, the first challenge we wanted to hit was the fact that we have all of these entrepreneurs and many more who could not even find somewhere to put their products so that somebody will see the products and say, I would like to buy this, or I would like to import this, or I would like to export that. They didn't have anywhere to go. So we tried with the government through a program that was being done in 8 of the OMOA countries to get them to force the big supermarkets to take our products. Then they created little shelves. I mean, this is like 2-3 years ago, created little shelves and put a few products, but we still didn't have enough space. So eventually, I called up a few people. We decided to bite the bullet. We went to the Trade Fair Center, asked them for one of their rundown buildings, redid the building. 136 of us entrepreneurs are now in that building today called Togo Mall. But Togo Mall is not just a supermarket. It's a supermarket. It's because people can come in and buy things from there, but everything that you find in there is made in Togo. So it has that national value addition, whatever you want to call it, behind it. Secondly, it's an incubator accelerator at the same time, because as many of the entrepreneurs in that building never really sat down and thought, oh, so how do I get into an accelerator? Beyond a few who joined 3-month programs here, 2-month programs here, where all they did was, had people come in and out, or they sat in front of computers, and when the 3 months was over, they didn't know what to do next. So now they're sitting in a shop with and there's a product. Their products are in a shop. We can look at those products together through a system we've put together, which we're calling the Entrepreneurs Village Initiative, where we have experts who can look and say, okay, this is your product, maybe for it to get better, you will need to do this, or they get somebody wants to order 1,000 pieces of, cereal bars, Togo Mall, MALL. So you want to buy, somebody's producing cereal bars and somebody wants to order 500. Under normal circumstances, the founder does not have enough money to invest, to produce. Togo Mall, we're able now through a system we're developing to say, okay, let's look at it and let's see how we can help. So this is the process that we are working. So we're working through a process. We are 1 year and 6 months and a few days, not even up to 6 months, 1 year and less than 6 months old. But the process we are trying to follow is a process that not just takes an entrepreneur from the idea to producing a product, but to become ready for any type of investment they will feel comfortable with. And when it is not able to come from outside, that we should be able eventually to be able to support them to get it. So investing in community is what is one of the things we also have behind our minds, because at the end of the day, as I said, it's a community, it's creating even value chains. I'll give you an example of one value chain that we're hoping to work with even as we evolve. For example, groundnuts. Lots of groundnuts, but not enough people producing groundnut oil, which is something that would be very needed, is very much needed around, because people need it for cooking and for many other things. So the idea now is we're discussing with those who are selling groundnuts in Togo Mall to say to them, you know, some people will do the groundnuts as in we want to put it in our mouth, but some people have to turn this thing into oil. Some people have to add it to their soaps. You know, we need to be able to evolve with complete value chains on products in order for us to be able to enter into a more competitive market, and especially looking at the market beyond our countries. So issues around regulatory hurdles, again, through Togo Mall, when there is a problem with the tax and so on, we're able to come together and say, okay, how do we support X to be able to overcome this? So we're dealing with issues around structuring. We are dealing with having the right, not just the structuring of the business, but even the structuring of the mind of the entrepreneur, which in itself is a problem. I don't know, maybe in South Africa it is not, but I know that in this part of Africa, it is a major problem. Structuring, you know, the mindset of the entrepreneur, building the resilience through community support. So for me, and for us now, this is what we mean when we talk about creating access to market. Access to market cannot just be in theory, it has to be in reality. So we have approached the Africa Free Trade Zone framework, where they have adopted us as one of their impending trading companies. And this is one of the areas, this is one of the ways by which we are going to be able to open up a bigger market for entrepreneurs in Togo Mall and others who will eventually be interested from this end. So what would I like to, what I would like to say to fellow angel investors is that we are on the right track, but I think we need to do a little bit more. I personally, I mean, you know, debt financing, I mean, even the Togo Mall business itself is financed by debts, as it were. And that which is, you know, having to put the money down, at least, you know, most of it, 80%, almost 90% of what it cost us to create this access to market through the vitrine and through the supermarket and what have you. And now that debt financing must be well thought through. It must be patient capital. It cannot be capital based on pressure. And I think the last thing I would say is we need to really, really work hard on blended financing, including the post-financing support that people need if we really want our ecosystem to be stronger and to really be able to be competitive globally. So I will stop here because I was given 10 minutes and I think I've used more than 10 minutes, but and I'll be open to answering questions. I mean, I have a lot to say, but I try to summarize. Thank you.
Thank you, Olatokunbo. If we can get anything from her is that we need to have investment beyond capital. And also we need to look at different models of finance, which is why we are here today. And now I would like to welcome back Jill and Egla to just take us through now the final session, and now we'll be able to open a Q&A so that we can have an interactive session.
I have to say, I don't know how I'm going to go after after that. That was really impressive, Olatokunbo. It was great to hear the real life practical examples of, as you say, there's much more than just the check, and it's much more than just the training. It's this overarching thing that actually provides value and keeps these businesses growing rather than failing within their first year or their first 5 years. So really kind of this next session is a short and sweet insight into how we think about debt and how we actually came up with this debt investment process. I think the most important thing we start with any investment process or any investment is the market size. How big are we talking here? As we mentioned, there's 245 million SMEs in Africa. In our own market in South Africa, there are 40,000 SMEs that are doing at least $250,000 in minimum revenue. And we have around 20% of the SMEs in South Africa that are operated by women. So that makes 9,000 female-led SMEs. And around 63% of businesses are in retail and manufacturing. So what's interesting is that we'll be focusing on 250K minimum revenue, but also infrastructure heavy businesses, your traditional businesses. Think a food manufacturer, a furniture manufacturer. These are the types of businesses that we'll be investing into. We're also looking for female-led and then operating within Southern Africa for at least 2 years. Now we've got a decent market size. We've at least 5,000 SMEs, and we're looking to invest and provide debt to 28 female-led SMEs. So we're only targeting 0.5% of the market. And how do we actually create and get access to these customers per this like SME profile that we're building? And I think about it as our SMEs, as our customers. How are we providing that value to them? So in terms of how we're building our pipeline, we specifically go with a relationship-based approach. We are leveraging my own kind of over 10 years experience in the investing world, Egla's an ex-SME operator and kind of a debt provider, to kind of utilize those networks of angel investors, equity providers, to actually build a referred base of SMEs. And we have partnerships and sources with 22 accelerators, 5 kind of partnerships with other equity providers or other providers, and then 6 angel networks that we're working closely with to actually source these opportunities. We've identified 34 SMEs. We have 7 potentials in our shortlist. We have 4 that are in due diligence, and we have 2 approved investments, and we're targeting 3 investments by the end of April. And if we move to our next slide, we do not provide, as Egla mentioned, we do not provide debt within 24 hours. And the reason I laughed when she rolled her eyes and said we do not do this is because our investment process, we tell our entrepreneurs upfront, our investment process takes a lot of time. So for us, we're saying, at least kind of 6 to 8 weeks, and potentially even kind of 3 months we're looking at is the process that we're taking these entrepreneurs through. It's intense because what we're doing is we don't want to just be the debt provider. We want to be the debt provider that acts like an equity partner. It's about starting you with the $5,000 check, but how do we grow your business and be that provider so that when you're growing, you actually can get to the $450,000 check? Our process, we have kind of a data collection, which is quite rigorous. We have intro calls, site visits. We ask for financial DD. We then assess the business and then take that to our credit committee. We have as Egla mentioned, an awesome credit committee with myself and her, and then also Samia Tanani, who's bringing all of the experience. Each investment has to go through 2 decision gates via our credit committee before it gets approved. We then do social DD and see willingness to pay and kind of take them through that, do legals, and then we integrate with their systems. One of the biggest issues is reporting and how to actually create that reporting for them. So everyone has QuickBooks. We have technology that integrates in with their QuickBooks so that we can reduce that reporting piece and then also have integrations into their bank account. We deploy capital, but then it's all about monitoring. And the monitoring that we do is not only check in every month. It's 28 SMEs. We wanting to be holding their hand at every point. We're assuming only 16 will go through the process that can actually keep revolving more capital and keep scaling. We want to be doing all of the handhold supporting. So, connecting them with angels that can help expand their business, connecting them with potential equity providers, other debt providers. So yes, a rigorous investment process. If we'll go to the next slide, I'll highlight a little bit in more context where we dive into. So our investment requirements, we are looking at annual revenue that is at least 5 to 10 times the loan amount. We're looking at annual net profit that is 20 to 30% of the loan amount. And our requirements are that they are female-led SMEs. For us, that means there's a female founder or co-founder or a director, or it's the female director or woman is part of the business in a major decision-making role, or that the business supports female entrepreneurs in its supply chain, or its products benefit women. What we're looking for is the 3 key ratios. For us, it's about liquidity, liquidity, liquidity. Do your current assets cover your current liabilities? We're looking for a greater than 1 score. Leverage, we look at what is the kind of debt to EBITDA, right? And we're looking for guys that are at least 3 times or lower. We're not looking for highly geared businesses because then we're standing behind, then we're not doing that senior debt tranche. We also look for a debt service cover ratio of at least greater than 1 so that their EBITDA is covering the total debt plus any finance costs. We'll highlight into the next slide, please. So we love due diligence when it's debt and we're talking early stage businesses. Due diligence is everything. So we have a relationship-based approach to it as well. So often we'll be getting referred to these SMEs, but we do rigorous financial DD at the very beginning. So we ask for 3-year financial statements, income statements, balance sheets, cash flows, 3-month bank statements, the last 12-month revenues by customer, and we would do a deep dive on kind of the SME's financials. We rebuild the financial statements, we review any discrepancies between bank statements, customer contracts, and the management accounts, and we dive into an affordability assessment. So what is the effect of the loan on the gross margins, and what is the SME's fixed costs that they're going to have to cover with that margin? The social DD we do, and yes, we do a lot of due diligence, but what we're really trying to get out of our due diligence is providing value to our SME. So we'll do customer and supplier meetings, investor and network meetings, we'll do a complete due diligence, but at the end of it, what we're really trying to do is understand this business and provide value and insight to the founders to make this business more sustainable, more robust. We'll help prepare budgets and create repeatable processes around budgeting for projects. We provide ESG governance strategies to mitigate identified risks. We also can provide deep dive cost analysis and strategies for improving margin. And we adapt customer and supplier contracts to take into account of previously unidentified risks. So it's all about for us making this business stronger, more sustainable, and that it can actually think about, okay, what are my next steps? How can I achieve that growth? And how can I utilize this capital to my best advantage? If we go to the next slide, please. just outlining kind of our legals, we have a master loan agreement. So we typically scale the short-term loans over kind of a 3 to 6 month, and then we get to kind of a 12-month revolving facility. The master loan agreement outlines kind of the relevant securities that we take. And we also ask for visibility on the business bank account. We actually take security on financial assets, but also a floating charge on the business bank account for the amount. We do lots of system integrations. Yes, we invest in traditional SMEs, but we're making their lives and our lives better through a lot of technology. We're leveraging the people and the tech providers that have done this before. Unpack, which has been, utilizing kind of revenue-based financing to do SME debt. We're have purchased their loan management system and are working with them to kind of build that on. And we're also working with other providers like Vula, which is automating things like building out investment memos so that more of the value is to providing resources to the entrepreneur rather than asking them for a whole bunch of information. Next slide, if you don't mind. All right, a little bit of a case study. So I didn't want to do our first investment as a case study, Horizons. It was a bit of a slam dunk. So it doesn't teach us too many things about our process. I think they, had more than a 1x liquidity ratio. They're doing kind of at least $250,000 in revenue, and had a 20% EBITDA margin, and had low leverage of kind of less than 3. But the opportunity I want to speak to you about today is one that we spent a lot of time with, but then we unfortunately had to pass. And I think this highlights the thinking process we have when we're actually looking at these opportunities. So this SME produces a South African manufacturer of pickles, achas, condiments, and cooking sauces. They provide their own brand and white label manufacturing for ShopRite Pick and Pay food lovers. It was started 19 years ago by a female entrepreneur, and she has been employing 22 people. She's, been consistently profitable, but in the last year, she saw her EBITDA become negative because one of her customers actually pulled an order for kind of their own brand of products. And they were coming to us for working capital financing. When we looked at the opportunity, we saw decent revenue of kind of 2 million rand, at least $100,000. We saw that they were liquid, they had enough current assets to cover their current liabilities. And we also saw that they were, turning over kind of orders and had decent purchase orders coming in from large customers. But the reason we passed is for a few reasons. One is that their leverage is still already high. It's higher than 3 times. It's around 6 times. That means that you're adding more leverage to a business that is already over leveraged. The next thing to consider is that their revenue has decreased. So in the previous year, they were doing 4.6 million, around $250,000 in revenue, and now they're doing 100,000. Yes, it was because of that drop, but how are they going to make up that difference? And then again, saw positive EBITDA, and then that went to negative. When we look at this from kind of a bust, base, and bull case, if we think about starting this at a high risk opportunity and we test it out with, less than our initial check of $5,000, we do a smaller amount. We do $2,600, and they don't pay us back. We haven't lost anything in that transaction because it's a small check and we're managing our risk in that way. But if, for example, they could pay us back, we would be doing small loans with them, but of around kind of, $7,000. On the real bull case, we would be doing loans with them over kind of a 4-year period of 52,000. And that's when we're looking to actually get to businesses that are revolving 450K, you start to realize that they're too small to actually get to that ability to start being able to revolve more and more. And they've kind of got that decreasing revenue and EBITDA that's getting a bit shaky. But this is a business that has been profitable and we want to support them, right? So why wouldn't we test it out, take the best case and check it? The issue is affordability. This business has great execution. It's got 50% gross margins, and it really knows how to build revenue and deploy on it. But the issue is that often these large corporate customers, ShopRite, Pick and Pay, they take a 25% rebate on early repayment. So that 50% margin then disappears to 25%. And then you're now providing debt on top of that, and you're charging, kind of reasonable rates, but they're also already over-levered, so they have to be repaying other debt. For us, when we looked at this business and we realized that our debt would be reducing that already reduced gross margin from 25% to around 10%, and then we looked at their fixed expenses and realized that a 10% gross margin isn't going to cover those monthly fixed expenses. You understand that even though they are great executors and that risk is lower, their affordability risk is so high that we shouldn't be providing them with debt. We also shouldn't be over leveraging a business that already has debt, that has tried to kind of solve that issue. So for us, this was one where we said we had to pass on the opportunity. So I've tried to outline why, our thought processes. For us, it's about commercial decisions, the impact, but then also, are we going to make a better, more sustainable business by providing them with debt? Or do they need another source of financing to actually help them here? In this situation, it would probably be more grants or equity investment that would be right for this opportunity. Sorry, I haven't left too much time for questions. Apologies. But thank you so much for being with us on a little bit of a case study through MsFiT Ventures process. Thank you so much.
Thank you, Jill. I think we can just take a few questions. I see Egla has also been responding to some of the questions that have been coming on the chat. So if anyone has a question that has not been answered, feel free to raise your hand and we can be able to hear you, or also you can put it in the chat.
I see there is one question around the 100% interest income. So we aren't ensuring that we get 100% interest income. Apologies, the way I structured that slide maybe was a bit disconcerting. How we're kind of creating our interest income is that would be revolving the facilities. So we provide 3 to 6 month term loans, and this would then they would repay it, and then we would be able to revolve part of the facility and then grow that facility as well with other income that came in. So that's kind of how they would be growing from a lot faster. Thanks so much, Karaba.
Okay. Also, another thing is, let me just put the feedback form here. It also allows you to ask your question in case you want to, you want time to think about it and you have a proper question. Let me just put the feedback form, where also this form will enable us to get your contacts and also link you up with MsFiT to further this conversation and see how you can be a part of their current fund that they are raising. I see there's another question here. What is your offer? Yeah. Are you open to investment from angel investors? If yes, what is your minimum request?
Wilson, we love questions like that. Yes, we are definitely open to angel investment. We're looking for around kind of that 1.5 million that'll be going through kind of that Mauritius structure to kind of help and get those angels in. And our minimum request is $100,000 US. And if you have any more questions and you would like to reach out directly, I'm putting our email addresses in the chat.
There's another question from Cynthia.
Thank you so much, June. The dividend payout cadence, we typically would be paying out from the second year. And it's more that we're showing that it's available, but we would prefer to keep it in for the first 4 years of this proof of concept. The aim is in future that we'll be doing it every 2 years.
I don't think we have any other question. So I will share again the link to the interest form where you can share with us your details and where we can further the conversation, where we can have a one-on-one conversation where you don't have other people on the call with you. We can give you undivided attention. And yeah, we have come to the end of the session, and I would like to thank MsFiT Ventures, Egla and Jill and Olatokunbo, and also Fadilah for ushering us in this session. It was such an insightful session. And our partnership with MsFiT Ventures is to continue to offer knowledge and to our commitment to offer other financing models available for angel investors in the continent. As Egla mentioned, that in comparison to like US, where the ecosystem is like 79 years old, for Africa, our area, our expertise right now is to offer more knowledge so that it can be able to guide the decisions that we do make. And we look forward to having more of these sessions to just educate you and to offer you opportunities where you can be able to make a return, and a quick return compared to equity. So yeah, I thank you. I've shared the link.
Can I just say one thing before we let everybody go? As part of our partnership with ABAN, we obviously want to increase angels' access to a debt product. So 100,000 is our minimum, but then of course, if you are within the ABAN situation and you're able to put together a few of your friends, we are willing to talk about that as well.
Yeah, that is good. So it means you can come up, you can also identify yourself and say, maybe I have this ticket and I'm looking for other people at ABAN. We can help you to get other members to be part of your syndicate and to raise their 100K. We are always for pulling capital together so that we can do so much. And when we work together, we move faster. So yeah, we have come to the end of the session, and thank you for joining us. Until next time, bye.